This is Jeff Cooper with the Daily Market Report coming to you before the open on Wednesday, October 17th. It was a familiar scene that's been played out after virtually every dip over the last 9 years. Just as soon as it looked like the bear poked his head out of hibernation, forcing the bulls to turn tail, the shakeout turns to be a viable dip. Notwithstanding some dips taking weeks or months to play out. So the question is this time different? Let's drill down to take a look at, before we do that, I wanted to say the February shakeout was a sharp and short 6 day scare. That's right here. And that's in keeping with the idea that setbacks in raging bulls are quick plunges. However, it took the S&P 7 months to score a new high. Back over here. The other day in our daily market report, we offered the time tells trend, noting that the February waterfall decline, the waterfall part of the decline, was 6 trading days, with the October waterfall decline so far being 6 trading days. This part of the decline right here, not from the high, but just this waterfall decline, again being 6 trading days, at least so far. Time has not overbalanced, which is an important technical concept. Yet, a decline below last week's low would be a glaring bearish signal of an overbalance in time of the prior large decline, the February decline, time-wise. So before the verdict is delivered that the current setback off the September peak is just another buy the dip opportunity, it may be worth considering that the recent high was consistent with the idea of a late stage false breakout over the January blowout peak. In other words, that this breakout here was a late stage false breakout after a long 9 year bull market over the prior peak. So this was a warning shot over the bow, the grind back up, and a late stage false breakout. The ensuing angle of attack to the downside here, knifing back below the January top, backstops this idea. Likewise, so does the break of the April May. Here's the April low and the May low, the little double bottom here, that perpetuated the last leg up. This double bottom perpetuated this leg up to test the January high, and this trend line was broken here with authority. The idea that the September high was also a late stage false breakout of the January peak is also backstopped by the idea that the 3 month structure from late June, that's this higher low here, that this 3 month structure was broken with authority as well, on a breakaway gap actually, on October 4th. Let's drill down so we can get a better look at this. Notice here that Tuesday's big rally backtested this April-May trend line. It kissed it. A push higher today will satisfy a 50% retrace of the decline. That comes in at 28.25, and we closed at around 28.10. So 50% of the range from this all-time record high to this low comes in at around 28.25. At the same time, trade above Tuesday's high by even one tick will turn the 3 day chart up in the wheelhouse of this resistance. If the line of least resistance is down, in other words, at least the short to intermediate term trend is bearish, a turn up in the 3 day chart does a good job of defining a pivot high. In other words, when the line of least resistance is down and an item tries to stand on its tiptoes, it's usually a high, and vice versa. If the line of least resistance is up, a turn down in the 3-day chart does a good job of defining lows when the market is in a crouch. So today is important because it will be an opportunity. Well, let me say this. Um, if indeed the line of least resistance is down, as we were saying, then the possibility of a turn up in the 3-day chart should define resistance soon in terms of both time and price. Today is also important because it will be an opportunity for the S&P to register a follow-through day. A follow-through day occurs on the 4th to 7th day after a low from a hard sell-off. The percentage gain needed for a follow-through day signal should be at least 1%, and volume must rise versus the prior session. The more substantial the volume, typically the better the signal. So a big rally of at least 1% on increased volume on the 4th to 7th day from last Thursday's low could signal a new bull phase. Is it perfect? No, no signal is perfect, and I'll believe it when I see it. So it looks like the rubber meets the road over coming hours and coming days, with a possibility of a follow-through day into the crosshairs of this 50% retrace of the recent waterfall decline. They say short, sharp shakeouts are the signature of bull market corrections, and vice versa, that short, sharp rallies are the hallmarks of bear markets. So what exactly is it we're dealing with here? Will the massive risk off that we saw in October, led by the defanging of many glamours, be replaced immediately by huge risk on? While we have seen a number of one-way markets and reversals over this bull market, the odds are great that even in a bullish resolution, this plunge low will be tested with a 50% chance of a new low, an undercut low below 2700 S&P. In a bullish pattern, they need to hold up for at least 3 days here to build a base. That's not what we have, at least so far, from the lows. The bear case is that Tuesday was 90% short covering, and the sellers will be right back in on any 2-hour loss of upside momentum. So the big short squeeze came yesterday, approaching a near picture perfect 50% retracement to 28.25. Remember, as subscribers to my report know, that the closing low at 27.28 precisely satisfied a 360-degree decline, or one full price cycle, 360 degrees, from the 29.41 all-time high. This is measured by what is called a square of 9 chart. In Monday's report to subscribers, we stated that if there is a rally to 27.80 to as high as 28.08, I think it will be the last graceful exit if a further meltdown is going to play out. Usually, you only get one chance before the plug is pulled after a spectacular short squeeze. I can't help but wonder if the short calls and long puts for the 2800 S&P strike, the 280 SPY strike, for Friday option expiration lit a fire under yesterday's squeeze. If I had told you that after the close on Monday, that Tuesday there was a 100% chance of a 500-point move on the Dow, but I didn't know which way it was, after Monday's last hour's swoon, you would have bet down. Let's take a look at an hourly chart, or even a 10-minute chart, to see what I'm talking about. Okay, so here's the 10-minute chart for the S&P, and you can see the last hour breakdown and it breaks support on Monday, and then you get Tuesday's gap and go. You have a gap up, you have an opening range breakout above the first half hour's range right here, the first little pullback, and it was off to the races. It was a machine day up, a grind the whole way with no meaningful pullback. So that's the market we're dealing with, and it implies the last hour on Monday was likely a setup. Be that as it may, it set up the triangle pendulum long pattern shown on an hourly S&P from Monday's report. Let's take a look at the hourlies and you'll see what I mean. So before Tuesday's big rally, the S&P had traced out a pennant or a triangle. As you can see right here, put a trend line. It's broken in the last hour on Monday, and this is the top angle of the triangle, the upper rail. So right here and right here, and Monday's last hour break. So it looks like it was a setup. Maybe somebody had Netflix earnings in their pocket. Who knows? It is what it is. The break through the bottom of that hourly triangle saw a gap and go through the top of the triangle on Tuesday, eliciting a rocket right to the 50 hourly, the 50 period MA on the hourlies right here. So after this dance at the 20 period MA, the 20 hourly MA, this red line, the market exploded to the 50 period on the hourlies, which ties to this back test which we showed on the dailies. This line is from the April-May lows. So this is a big inflection point. It certainly smells like Monday's last hour swoon, followed by Tuesday's gap opening, may have been orchestrated. The bottom line, back below 27.98. Let's take a look at the 10-minute again. So back below 27.98, this little high, and back below the short-term support right here. Actually, this is 27.98 right here. Back below this last little consolidation warrants caution, especially after a possible first hour high that fully satisfies the 50% retrace at 28.25, and especially if Netflix earnings do not provide more rocket fuel. And that's it for now. Good luck trading today, and with that, I'll let you go.